Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, we're back here on the Investor Coaching Show. Paul Winkler, Jim Wood. I'm 45 and expect a good long recession soon. Oh, good for you. I love this. MarketWatch. They write in, I've got a question. I got a question for you. I'm expecting this. I've got all my money either overseas or invested. What kind of question is that? I've got all my money overseas or invested.
It's buried in Ireland.
It's like when you invest in the United States, it's investing. And when you're overseas, you're not investing. I'm not exactly... I crack up. And it's, just with all due respect, what these questions. Now I'm looking ahead at the S&P and short ETFs. So what's next for me? Probably bankruptcy, because you invest this way, you're probably not going to do well. And I just crack up the question. I'm 45 and I expect a good long recession. Okay. Did you know, sir, that the stock market typically goes up most of the time during recessions? Probably doesn't know that. I mean, that's the interesting thing. People don't realize that out of, 3 out of 4 years, the market goes up, and the market goes up even during recessions.
Well, that and the joke that, economists have correctly predicted 35 of the last 15 recessions.
Yeah, something like that. I think that's it. Yeah, the data is somewhere in that neighborhood. He won't do a leverage short Russell index fund again. Why? Why won't you do that again? Maybe because last time you gambled with your money that way, you lost your shirt. But now I'm going to do something else dysfunctional. I won't hit my toe with a hammer again, but I'll sure hit my thumb. I mean, like what? I think the S&P and NASDAQ have a long way to drop, but I won't bet against the Dow or the Russell. I just love it. He's using the word bet. I'll bet a little money on 3x short index fund. Every bit of my money on this moment is either in overseas or invested, contrary to conventional wisdom. Small caps are a risky space, and aerospace is all over the place. FANG is a toxic waste for me. Facebook, Amazon, Apple, Netflix, Google. I think that at 65, eating superfoods and avoiding bad behavior, you plan investments for 15 years out. What does superfoods have to do with this investing dysfunctionally? Maybe it'll make him think more clearly. I'm not sure. I don't know when people actually retire now. Is it 72? Would hiring a financial advisor be wise to this stage? Only if the financial advisor doesn't gamble like you do, which most do. But
where's this question from?
This is in MarketWatch. This is a question in MarketWatch.
They did say something correct.
What was that?
Aerospace really is all over the place.
Oh, stop. That wasn't funny. Okay, so, and what reminded me of this segment on CNBC. It was this one here. I love, they interview these people, and this is exactly the state of investing so often. Just check this out.
Paul, thanks so much for joining us. Appreciate it today.
Thanks, Kelly.
Paul Christopher, Wells Fargo Investment Institute. Coming up, you just heard the case for financials.
Okay, so you have this person for Wells Fargo has just made a case for why you want to invest in financial stocks. Okay, so that was the whole segment. Why you ought to do this. Major investment firm, too. I mean, just, right there. Wells Fargo, right? Okay. Now what does she say next?
But our next guest says you should short them. It's the worst sector so far this year, tracking for its worst month in 3 years, and we'll talk about why he thinks there could be more pain ahead.
So one of those two people is going to be wrong, right? It's just what cracks me up. You have this major investment firm, you need to buy this. Then you have somebody on the other side interviewed next, and you're just getting whipsawed as an investor.
And that's really, though, it's kind of a microcosm of markets working, right? It's just like, some person, they have access to the same data. They just have different interpretation. One of them's going to end up selling it to the other one, and it goes back and forth. And eventually, everybody's input comes to that, and they settle on a price that is a really good estimate of the company's intrinsic value.
Oh, that's exactly what it is. But, we don't recognize it as. We feel like when I'm going, gosh, I'm thinking a little bit nervous right now. I think I'm going to move money out of the market. I'm going to put more money in, fill in the blank, whatever it is. Because I'm a little bit nervous about what's going on. We feel like it's prudent. We feel like we're being wise and prudent with our money when we do that. We don't think of it as being anything. And, like, for example, you talked about earlier about the tariff thing, Jim. Mm-hmm. You made that comment. It said, last year, what was the big market mover in March? And you said it was tariffs. And you go, well, what were we worried about? What was going to happen? What were tariffs going to cause that was going to be so deleterious for the stock market? What was going to be so bad?
Well, lots of things. Prices were going to skyrocket. People were going to quit spending money.
Yes.
Yeah.
Exactly. Inflation was going to be the issue, right? Article in the, I think this was the Wall Street Journal, was this? I think maybe, yes, it was the Wall Street Journal. How U.S. businesses are shaving billions off of their tariff bills. This I thought was fascinating. Because when we talk about companies, and I made the comment earlier, I said, when you look at recessions, we see that the stock market goes up more than it goes down, even during recessions. Why? Because companies have something else at their disposal, the ability to cut costs during a recession. They can lay off people. They can close factories. They can change, let's say, suppliers. They can do substitute one product for another, a cheaper product for another product that was more expensive to save money. And people do that too. But here's the thing, is you look at this and say, well, okay, so what can companies do? This was not on my radar screen, that they were going to find ways to avoid the tariffs. Check this out. This is how they did it. So how U.S. their companies are shaving billions with a B off their tariff bills. Typically, an American importer, they said, declares the value of goods it brings into the country based on what it pays. If the American furniture retailer buys Chinese trading company $300 for a sofa, it's going to be subject to a 50% tariff. Now, they would declare, of course, it's a $300 item. The tariff would be $150, 50% of $300. But under a legal precedent established in the 1980s, and this is what I love, a company getting in there and getting really creative. Companies that dig deeper into their supply chains can report what was paid at first sale. So suppose that an original manufacturer of a sofa sold it for $200 to a trading company, which marked it up to $300. The American retailer can declare the value of the sofa not at $300, but at $200 and drop their duties down by a third. Go from 150 down to 100. Using the first sale rules is one of the several steps companies can take to lessen the tariff hit. They can also move production to lower tariff countries. And that's the other thing that companies do. They go, oh, you're going to hit us with this big tariff. If we go from this country over to you, we'll route the good over to this country and then bring it into the United States. So they'll find ways to do whatever they've got to do.
Or bring it to the U.S. to manufacture it.
Exactly. That's the other thing. And it takes a little longer to do that. So they might have to use some of these intermediate steps like going through a different country. They can also move production to lower tariff countries. So they don't even have to go to the U.S. They go to Mexico, for example, whose goods are often tariff-free thanks to the trade deal with the U.S., or tweak the composition of their goods so that they qualify for low tariff product categories. And, and Trump has exempted some goods such as smartphones and beef from his tariffs. And I'm thinking, we're going to bring this sofa in there. But, you can really use it as a cell phone to call your mom. What do you tax us on that? I don't know. Kidding. But obviously, companies, and the point being that companies get really creative on how to avoid expenses and and that's what I love about the stock market. It's what makes it so stinking hard to predict what's going to happen. Companies are constantly rearranging the furniture, so to speak, pun intended, to take advantage of whatever the circumstances are that change. Just like wealthy people. You think about it, when you have what they always say about we need to tax the rich. And I'm like going, yeah, good luck with that.
Yeah, what's happening to the billionaires tax in California? The billionaires are leaving.
Exactly. They have the greatest mobility of any group out there are the wealthy. And I use examples of companies that pick up their toys and they take their companies to other countries and they take them to tax havens. And the tax havens are out there because they benefit from those companies being located or domiciled in those tax havens. And then the example, I've used this a couple times here on the show, but it bears repeating. Warren Buffett saying, oh, here's what we're going to do. We're going to have company A loan money to company B. And instead of repatriating money back to the United States and paying 35% in taxes, we're just going to loan the money and then company B loan money back to company A. And you don't tax a loan. And we've loaned each other money, and then we repatriate the money. It means it brings it back to the United States, in other words, and we don't have to pay any taxes. And it just go, well, they figured it out. And if you can't figure it out, they leave. New York City. Everybody's talking about New York City right now. You've been hearing this stuff going on?
Oh, yeah. Well, you look at you look at the states that have no income tax versus the states that have super high income tax rates. Where are the people coming from and going to?
Oh, yeah. They're going to go to those low tax states.
Right.
Is exactly
and
what's going to happen.
That certainly includes New York. So,
well, yeah. And there was an article in the journal. It was an essay, and it was entitled, "What is a City When Its Wealthiest Leave?" I mean, it's
New York. it's social.
I guess. But the stickiness that once anchored people to and capital to great cities is gone. They said, and it's not coming back. And they were talking about, Google co-founder Larry Page making headlines, spending $188 million on 3 Miami mansions. And they were talking about the spending spree, as you were talking about, Jim, as California considers its wealth tax to impose a one-time retroactive levy on billionaires. This fueled speculation that they've had it with the Golden State, New York City, as we talked about, another one coming up.
I just read there was somewhere that they closed a Target and basically ate a $110 million lease just to close the store because of the problems that they were having there.
Sure, chump change.
Yeah.
Chump change. It's a lot cheaper to pick up your toys and leave. And, maybe people wake up to that. I hear this all the time. We need to get these people. And I'm like going, good luck. But, it's been tried over and over and over again. And that's what wealthy people do. And the beauty of it is they, I talk about companies. Companies adapt to circumstances. Wealthy people run companies quite often. They know how to adapt. They've got some pretty good legal advice and tax advice when it comes down to it. And they will use it to avoid that. So it is why it is futile to try to act that way and think, it was that study that was done by Rex Sinkveld, Art Laffer. They literally went around the country looking at every It wasn't just city governments, but it was county governments. They were looking at states, and they were looking at where taxes were increased and what happened to revenue. And in every case, revenue went down. It didn't go up. And that, hence Laffer curve, where he talks about that. If you'll reduce taxes, you increase the amount of revenue. And that is something that is absolutely key to keep in mind. You can't look at that. And I've talked about this with people where you say, what if I took the entire wealth? All right, I was having a conversation with a young guy about something. I can't remember what the heck it was. We were talking about an expense every year. And if you took the entire wealth of, I picked a certain group of people, a certain level of people, and I said, yeah, that would fund that thing, that project that you're talking about for about a third of the year if you took all of their wealth. You've seen that kind of stuff.
Yeah.
before.
Oh, yeah. There's lots of it out there. Yeah. Just like, we're going to tax of billionaires. Well, it might make you feel good, but it doesn't accomplish much.
Yeah, it really does. But, just recognize that this type of discourse has gone on forever. You had a tax rate, prior to the Kennedy administration of over 90%. People forget that. There was an income tax rate of over 90%. During the Kennedy years, the tax rate on wealthy people was reduced to something like 60%. How many wealthy people actually paid it? They didn't. But it was Reagan paid 1 year. Reagan paid an awful high tax rate, and that's when he was fed up with it. But anyway, hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement. Real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. Hey, what's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. All right, we're back here on the Investor Coaching Show. Paul Winkler along with Jim Wood. paulwinkler.com is the website where you can sign up for the podcast. You don't miss these segments, and they get delivered to you with the topics on there. And you go, hey, what are you talking about this week, guys? Well, that'll be on there. You can find out if you missed it. Anyway, so Jim, go.
So, financial crimes awareness. Got an email from Charles Schwab just talking about 4 signs to watch out for scams. Email is so full of them, from texts and things like that. They're going to try to get you to download stuff. They're trying to get you to log into some fake website and things like that. But 4 signs to watch out for: too good to be true offers. So a lot of times, you're going to get something free.
Or TV commercials. Like I've been talking about. I've been doing all kinds of things on TV commercials, and they say, you get a fixed interest rate, you have liquidity, it's really high, it's guaranteed. And they go, oh. It used to be, and one of the old guys used to work at WTN, used to talk about this all the time. He says, back in the day, Paul, he said, we had the FCC, they were really all over us, making sure that we didn't have things on there that were bad. But a lot of things get through now. There are a lot of things on there on TV.
Yeah, well, I just remember
radio. Sure.
There's no free lunch.
Yeah.
I mean, common sense, but people get sucked in. Hey, I get a free iPhone if I log in, or you won this thing.
Sure.
There's lots of things that they will do to get you to click.
Mm-hmm.
High pressure tactics, another thing, and you got to do it now. You got to act now. That's so many of them.
Sure.
Will have and if especially somebody gets you on the phone and say, hey, if you cannot do this now and you miss out, we got to move on to the next guy. You got to move fast on this. Things like that.
Right.
If they're pushing you, it's likely a scam.
And it's because that's how your brain works. So what happens, the way your brain works is the middle part of the brain, the emotional part of the brain, it responds much more rapidly than the front part of your brain does. I forgot how many times. It's a very, very high multiple of how fast that part of the brain will respond to information. But greed, fear, emotions, that gets hit first. And if you take too much time, if the person gives you too much time, what will happen is the front part of your brain actually kicks in. The front part is the logical, literal, language. We call it the L part of the brain. The left side of the brain actually does that, and it kicks in, and it will think through it and go, whoa, wait a minute, this is crazy. I shouldn't be doing this. So that's what they're doing. They're playing with your brain when it comes to that. Yeah, good.
Contacts from out of the blue. And this to me, there's what's called phishing out there. And most people probably know what that is, but there are really good looking emails that you think and it can be from a company that you use. It can be
that's exactly right. That's where it gets really tricky. Yeah.
Right. And then, we use DocuSign sometimes for documents and everything. Sure. I have seen some really good phishing stuff that says DocuSign needs you to sign this. And, if it looks tempting, but it's like, nobody sent me, I'm not expecting this, I certainly wouldn't click on it.
Yeah.
And I always want people just, whenever you're in doubt on any of this stuff, pick up the phone and call.
Yeah.
Go to if it's a website thing, go to that website, log in if it's a login type of thing, but just don't take the route through the text or the email.
Right.
Go to the
right.
company, make the phone call.
Well, the
like
deep
that.
fakes are scary, though.
Well, that's
people
coming, right? I
Yeah.
mean, it's scary now. But I think it's just scratching the surface on how good those things are going to be.
Oh, yeah. Yeah, and people are like, well, have a code word. Have a code word for you. And I'm like, oh, do we really have to go there?
I know. Yeah, the criminals make things hard on the rest of us, but that code word thing is actually a pretty good idea.
Yeah.
And of course, obviously never download anything, never click on any links, never share any codes. Somebody calls you and said, hey, we send you a code, or, did you get this code or something like that. It's just like, it's most of this, if you sit down and think it through, I'm not expecting this. I wasn't, you can avoid this type of stuff, but, never ever give out any personal information. Account numbers, certainly, Social Security, birthdays, never give out anything, and request that, who are you?
Yeah.
What number are you calling from?
They call you and then they say, we need you to verify your identity.
Yeah.
Just like, yeah, right. Okay, that's really good. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.